Hi, I'm Larry DeBoer, and I'm a professor of agricultural economics at Purdue University and an extension specialist in state and local government public policy. And this is the third of 4 videos dealing with life after recession, local government finance updates. And what I want to talk about in this video are the tax capped credits, the property tax caps in 2010. I want to point out that there is a handout available for this talk. You can find it at the address shown on your screen, and you can follow along with this talk on the handout and then have it for a souvenir afterwards. Well, as I said, we're going to talk about the tax caps and how that new policy is working here in 2010. 2010 is the first year in which the permanent tax caps are in effect. We are capping homestead property at 1% of gross assessed value, rental housing and farmland at 2% of gross assessed value, and commercial, industrial, and personal property at 3% of gross assessed value. And if you take a look at the first table here, we've got some data for the first 75 counties or so showing who's getting, what kind of property is actually getting the tax cap credits. And as you can see, about a little bit more than half of all the tax cap credit is going to other residential. Farmland is in the 2% category, but really not receiving very much in terms of tax cap credits. A majority, a little bit more than half of all the tax cap credits are going to rental housing in that 2% category. Homesteads receiving about a little bit less than a third of it, and other property, that's commercial industrial property, in the 3% category, receiving about 15% of the total. There is a fourth kind of a tax cap out there which limits the tax increases of homeowners who are over age 65, and that's providing about $2 million in tax cap credits altogether. Total credits for the first 75 counties for which we have data, a little bit more than $250 million out of a total levy of about $4.5 billion. That's 5.6% of the total levy, which means that taxpayers' property taxes are 5.6% lower than they would have been without the tax caps, but also means that local governments are receiving 5.6% less in property taxes than they would have received without the tax cap credits. And I'd like to take a look at some scatter diagrams now that show what's going on with the tax cap credits. This is the 2% category, and what it shows are all the taxing districts, all the different tax rates that are out there, and shows the tax rate, the net tax rate after credits along the horizontal axis, and the tax cap credits is a percentage of the levy, or the percentage reduction in property taxes and percentage lost in tax revenue that local governments have received. And you can see that it really gets going at a tax rate of $2. If you press the button there, you can see I'll put a line there on the $2 rate. There it is. And it shows that as a tax rate gets above $2, we begin to see a lot of tax cap credits and a lot of tax cap credit losses for local governments. The reason for that is because with rental housing, and that's mostly what we have here, the gross assessed value and the net assessed value are the same, and since the tax caps are applied to the gross assessed value and the tax rates are applied to the net assessed value, we can compare the tax rates and the tax cap and actually use that comparison. And so when the tax rate rises above $2, when the tax cap is 2%, we begin to see property eligible for tax cap credits at that $2 rate. If we go to the 3% category on the next chart and press the button and show the $3 rate, as you can see, only in taxing districts where the tax rate is above $3 per $100 assessed value will there be any property at all eligible for the tax cap credits. So that's mostly commercial and industrial property, and in only 9% of the districts, in fact, are any property eligible for tax cap credits, and are there any tax cap credit losses for local governments in those taxing districts. If you look at the next slide, though, this doesn't work. This comparison doesn't work for homestead property. And the reason for that is that homesteads receive lots of deductions. So the taxable assessed value to which the tax rate is applied is very different from the gross assessed value to which the tax cap percentages are applied. And but somewhere around $1.50, I think I've got that circled there, $1.50 is where we start to see the tax cap credits in taxing districts. So when tax rates are above $1.50, we begin to see homesteads receiving tax cap credits. Now I drew a chart here, and you can see this next chart shows combinations of the tax rates and the gross assessed values of homes that can make property eligible for the tax cap credit. So anything above and to the right of this line, any combination of gross assessed value and net tax rate above and to the right of this line makes a homestead eligible for tax cap credits. You can see that the line tends to trend downward. The reason for that is that the $45,000 standard deduction is fixed. It is a very big share of lower valued homes and a very small share of the upper valued homes that are shown on this chart, and this chart goes all the way up to $1 million homes. So the tax caps are more likely to apply to upper valued homes than lower valued homes. And we can see that in the next chart. And what I did was to divide up all the homes into categories by their value and took a look at what percentage of the homes of each value are actually eligible for tax cap credits. And as you can see, the number rises as the gross assessed value goes up all the way to about $250,000, and after that it stabilizes at around 35 to 40% of all homes eligible. But when we move up from $50,000 up to $250,000, more and more homes become eligible for the tax cap credits. We look at the next chart. It's another scatter diagram which shows the tax rate on the lower axis and the share of homesteads receiving tax cap credits on the vertical axis. And if we draw the two lines here, if you push the button, you'll see a couple of lines I've drawn, one at $1.57 and one at $2.86. In districts with tax rates below $1.57, very few homesteads are going to be eligible for the tax cap credits, but in taxing districts with rates above $2.86, almost all the homesteads are going to be eligible for, or almost all of the districts, I should say, will have homes that are eligible for the tax cap credits. It's not that all the homes will be eligible, but almost all of those districts will have homes that will be eligible. So somewhere between $1.57 and $2.86 is the threshold level at which tax rates rise to high enough to make homeowners eligible for the tax caps. If we look at the next slide, we've got some rules of thumb about the tax cap credits that I think will prove useful. Districts with net tax rates that are less than $3 will have no credits. In the 3% category, no commercial industrial properties eligible for tax cap credits. Districts with net tax rates of less than $2 won't have any that are eligible in the 2% category. That's rental housing and farmland. And districts with net tax rates that are less than about $1.50 will have no homesteads eligible, and those with tax rates above $2.80 will probably have homesteads eligible. If we move on to the next chart, I've taken a look at what's the impact of recession on assessed value growth so far. And what you've got there are the unemployment rates along the lower axis and the percentage change in homestead gross assessed values along the vertical axis. And you can see this thing has got a downward slope. Let's run a trend line through it. If we move to the next slide, there's your trend line. You can see it slopes downward. And we notice a couple of things. For one thing, for every 1% increase in the unemployment rate, you knock about half a point off the growth rate in homestead assessed value. And so recession really does reduce the growth in assessed value in our property tax system. Press the button again, you'll see I've got the 12% unemployment rate circled. That's the point at which, on average, homestead assessed value growth drops below zero. If the unemployment rate were 5%, if we push the next button there, you can see that growth would be, on average, about 4%. So if the unemployment rate was back to normal, if the recession was over, homestead assessed value might grow by about 4%. A couple of rules of thumb on the next slide about gross assessed value and unemployment then. An added 1% unemployment rate reduces growth by about half a point. Gross assessed value tends to be below zero when the unemployment rate is above 12, and when the unemployment rate is 5%, gross assessed value should grow in the neighborhood of about 4% per year. Well, that's some information that we're learning so far about how our new property tax reforms are working in the state of Indiana. I hope you found this useful. Thanks very much. I'm Larry DeBoer.